Index mutual funds and ETFs are two simple ways to own a whole market without picking individual stocks. And today we'll compare them in plain language so you can choose with confidence. In this episode, we'll define both vehicles, compare expense ratios, trading flexibility, and capital gains distributions, show a 20-year fee impact example, offer a practical decision rule, and close with one clear takeaway. An index mutual fund is a pooled investment that aims to match a market index and processes all buys and sells at one price set after the market closes each day. An ETF, or exchange-traded fund, tracks a market index too, but it trades on an exchange all day like a stock, with prices moving up and down during market hours. Both structures try to deliver the market at low cost, which means the differences that matter most are how you pay, how you trade, and how taxes may show up in your account. First, expenses are the quiet engine behind long-term results, because every fee is money that cannot compound for you. And compounding is the slow snowball that grows a small investment into a larger one over time. The key number to watch is the expense ratio, which is the annual fee the fund company takes to run the fund, expressed as a percent of your investment. Broad market index mutual funds and ETFs commonly charge very low expense ratios, often under 0.15% per year, and many large ETFs are even lower, sometimes near 0.05%. A difference that sounds tiny on paper can matter over decades, because 0.1% taken every year reduces your return every year, and that gap compounds. Second, consider trading flexibility, because how you buy and sell shapes your experience and your costs in small but real ways. Index mutual funds execute at the end-of-day price called a NAV, which keeps trading simple and avoids intraday tinkering that can tempt emotional decisions. ETFs let you trade during the day with market or limit orders, which can be useful if you care about exact timing. But with that flexibility comes one more moving part to manage. ETFs also involve a bid-ask spread, which is the small gap between the highest price a buyer offers and the lowest price a seller accepts at a given moment. That spread is an implicit cost of trading, and while it's often just a few cents on heavily traded ETFs, it can widen on smaller or niche funds, especially in volatile markets. Index mutual funds do not have a bid-ask spread because you are not transacting on an exchange. You simply get the single daily price. Third, understand capital gains distributions, which are taxable payouts a fund may make after it sells holdings at a profit inside the fund, even if you did not sell your own shares. Because of how creations and redemptions are handled, ETFs in many countries tend to distribute fewer capital gains than comparable mutual funds, which can make them more tax efficient in taxable accounts. However, in tax-advantaged accounts, where distributions are deferred or sheltered, that ETF tax edge may matter less, which means other factors like automation or minimums can take priority. Now let's make the fee impact concrete with one simple example over 20 years, using round numbers to keep it clear, and not as a promise of any future return. Imagine you invest $10,000 in a broad index for 2 decades, and the market averages 7% per year before fees, which is just a hypothetical planning number. If your fund's expense ratio is 0.05%, your net growth rate would be roughly 6.95%, leaving you with about 38,337 after 20 years. If your fund's expense ratio is 0.50%, your net growth rate would be roughly 6.50%, leaving you with about 35,236 after 20 years. That small-sounding 0.45 percentage point fee difference compounds into about $300 less in your pocket on a $10,000 starting amount, and the gap scales with larger portfolios. Therefore, prioritizing low costs is not about perfection. It is about respecting compounding and letting more of your return stay invested for longer. Next, let's weigh trading convenience against behavior, because tools are only helpful if they make good habits easier for you. If you value set-and-forget automation with no temptation to trade intraday, an index mutual fund that supports automatic monthly investments and automatic reinvestment can be the cleanest path. If you value portability across brokerages, want tax efficiency in a taxable account, or plan to move money between accounts without fund transfer restrictions, an ETF may be the more flexible tool. Here's an actionable decision rule you can apply today and reuse for years, which I'll call total cost then fit. First, choose the broad market index exposure you actually want, then select the lowest total cost option you can easily use, where total cost equals expense ratio plus typical bid-ask spread plus any commissions or account fees plus expected taxes in your situation. Then, fit the structure to your setup. If you invest automatically every paycheck and never need intraday trading, prefer the matching low-cost index mutual fund. If you invest in a taxable account or move providers often, prefer the matching low-cost ETF. Include one if then nuance to keep your choice practical rather than theoretical. If your broker charges a commission to buy ETFs or does not support fractional ETF shares for small recurring amounts, then a no-commission index mutual fund with automatic contributions may be cheaper and smoother despite similar expense ratios. Conversely, if you are outside a tax-advantaged account and your index mutual fund has a history of capital gains distributions while an equivalent ETF does not, then the ETF's tax efficiency may outweigh the mutual fund's convenience. Now, a quick note on tracking error, which is the small difference between the fund's return and the target index's return over time. All index funds and ETFs have some tracking error because of fees, sampling methods, and cash flows, and the goal is for that difference to be small and consistent rather than swinging widely. When comparing options, look for long-running funds with tight tracking to the index and a clear, simple mandate. Complexity rarely reduces tracking error in broad markets. Also remember the quiet cost of the bid-ask spread on ETFs, which you can reduce by using limit orders and trading during active market hours when spreads tend to be tighter. A common mistake is choosing based solely on the lowest headline expense ratio, while ignoring spreads, taxes, and your own behavior, which can erase the tiny fee win in real life. The concise correction is to calculate total cost for how you actually buy, hold, and sell. Then pick the option that makes your good behavior automatic. Because simplicity supports consistency, keep your selection broad, low cost, and boring, and spend your decision energy on savings rate and time in the market rather than product tweaks. You do not need to own both an index mutual fund and its ETF twin. One core holding can cover the same index exposure with less mental clutter. Reinvest dividends, automate contributions, and review once or twice per year to confirm costs remain low, and your allocation still fits your goals and risk tolerance. Finally, here is the single takeaway that keeps this easy. Pick the broad index you want, choose the vehicle with the lowest total cost you can use simply, and then leave it alone to do its job. If this helped you cut through the noise, like and subscribe for more clear, practical money guides.